Hi everyone, it's Jack about another video. Today I'm going to be talking about Intel, and more specifically, Intel's road to recovery. The $36 stock has been given a market cap of around $149 billion. That's down 31% year to date, down far from its highs, and down from $53 at the start of this year. Pretty poor performance. 52-week high of 57, 52-week low of 35.88. So it's right at its 52-week low basically. This gives it a trailing price to earnings ratio of 6, which is going to rise up in the future. I think the forward price to earnings ratio is about 10, still far below the S&P 500 average, and a dividend yield of 4% for a company that, while it's had some poor years, you've really got to be thinking that Intel has a strong runway ahead of it with the future growth of the semiconductor industry. So I want to establish where it is with its comeback. Some news came out recently. Look at its financials, look at how it's doing in its most recent quarter, look at its fundamentals, and see if I decide if it's doing well in its road to recovery or not. So an interesting update came out on Friday, and it's a bit of political wrangling. Intel is looking at building several fabs, as many of you know, investing a large amount of money. These fabrication facilities run into the tens of billions of dollars. They're building 2 in Arizona, they're building 1 in Ohio. The one in Ohio is going to be heavily supported by the CHIPS Act, legislation that's going to boost the US semiconductor industry as the US looks to secure its chip supply for the future, essentially American chips for America. $52 billion in assistance, of which some of that, or a lot of that, considering Intel is the largest US semiconductor manufacturer by far, is going to go to Intel, and they're looking at building a $20 billion plant in Ohio, and they're messing around a bit. It's kind of stalling. They're talking about they could move more investment to Europe, which obviously this CEO, Pat Gelsinger, talking, they don't want to do, because America is looking at being a really positive environment for semiconductor manufacturers, particularly Intel, so they're just looking for some leverage. But this is not really positive, is that it's slowing down, and the pace of expansion is slowing down based on this legislation. So it'd be nice if this obstacles was cleared quickly, but again, not a particularly bullish signal. Not absolutely huge news by any means, but Intel recently announced that its second generation Habana Gaudi 2 deep learning processors have outperformed NVIDIA's equivalent offering for AI time to train on an industry benchmark. This is really strong. Intel has had a significant knowledge gap and manufacturing gap, and just overall quality gap to the competitors, particularly NVIDIA and AMD in certain segments of the business. And this is what Intel really needs to be doing. It shows it's bridging the knowledge gap, it's being able to outperform in NVIDIA, and as you see in the next slide, some of AMD's offerings. It's just really positive. This is something Intel has been really struggling with for a while, so I'm quite happy that they're doing this. Obviously, AI and machine learning is something that is going to be an increasingly larger part of modern enterprise and our daily lives, and these chips like Habana Gaudi 2 deep learning processors are going to be a fundamental back for that. So Intel needs to get this right, and they seem to be doing so far. Another nice little news story that I saw was a market analyst at Morgan Stanley has been predicting that AMD Ryzen revenue could fall this year. AMD Ryzen desktop CPU revenue expected to fall around 26%, that's the market share, in 2022. This is mainly due to the success of Intel's 12th generation Alder Lake processors, which have been extremely well received. It seems that AMD are lagging behind with the next gen releases. Any weakness in AMD in any segment of the business is good for Intel, and this is particularly strong for Intel because Intel has been way behind, particularly from a consumer standpoint. It's been well known that AMD Ryzen chips have outperformed Intel chips for the last several years, and it's nice to see Intel is just clawing back some market share, clawing back some reputation. This is the type of thing it needs to do, incremental changes. Of course, the wider picture, they need to get fab set up, they need to be producing 3, 5, 7 nanometer chips, whatever they need to be doing. They need to be doing a lot more than just this, but this is a nice reputation grab, a nice market share grab, putting some pressure on a much smaller competitor and getting good work done. Absolutely massive positive indication for Intel, in my opinion. Not an absolute needle mover, not going to massively increase revenue by any means, but I think the reputational effects are quite big. The most recent financial metrics we have for Intel are the Q1 financial results. They recorded $18.4 billion in revenue, a 53.1% gross margin, and $0.87 of earnings per share. None of these overly impressive, down year over year on all fronts, particularly earnings per share down 35% year over year in what is admittedly a tough environment. But these were improvements over January guidance, which put the frighteners on a lot of investors, and so it should. But they were not incredible beats by any means. $100 million above January guidance, that's on over $18 billion in revenue, so not overly impressive, but it's a start. 1.1 percentage points above the January guidance for gross margin. Much rather see this gross margin back towards the historical averages of 60%. I think it will do it in a more normal environment. And the earnings per share, of course, needs to rise, but they have spoke about using some free cash flow and some cash to spend on improving the fabs. They have a lot of investments they need to do to catch up Taiwan Semiconductor and Samsung. And from resting on the laurels in previous years, there's going to be some spending down the road. But this is not the end of the world. And this revenue number is a lot better than it actually appears. Data centers revenue is up 22%. This is mainly due to a decrease in the personal computing segment, which is a much more variable segment, and data centers is a much larger growth base for this company. And I believe the personal computing one, it's not the end of the world to see a drop in that. There was some seasonal decline. They lost the CPU and modems business, which they sold to Apple, so they lost some revenue for that. Of course, it was down around 15-20%, so it's not the end. That's not the entire story, but in reality, probably close to 10%. Not the end of the world, in my opinion. The data center segment and a few of the other segments are far more important for Intel's future. A really interesting point in this business, which is not often talked about in the bull cases, is these three emerging business segments. Accelerated Computing Systems and Graphics Group, which is growing at 21% year over year. Very impressive, although recording an operating loss as it ramps. Mobileye, which is the self-driving segment, which they were talking about spinning off earlier on and generating quite a lot of money. I think this is a $15 billion acquisition. Again, revenue of $394 million, up 5% year over year. But this is really like a boom or bust type of investment. If this is involved in self-driving cars in any way in the future, this could be absolutely huge. What I want to focus on most is the Intel Foundry Services, which is a loss-making endeavor right now, but it's up over 100% year over year. Quarterly revenue up 175% year over year on increased tool deliveries and increased automotive revenue. This is essentially the segment of the business that is modeling from Taiwan Semiconductor. You give them a chip you want to make, they make it for you. You get nice margin, and Intel gets even nicer margin. You don't have to deal with the stress of having your own foundry. You don't have to deal with that initial startup cost with equipment repair, with capex, blah, blah, blah. Intel does it for you and generates a nice margin on it. This is a nice business model that I'm hoping they move further towards and increase this business. And while it is an operating income loss endeavor at the minute, I don't think it will be in 10 years, in 15 years. I think this is going to be a real needle mover for this business. I'm happy they're doubling down on it now. Now looking at some valuation metrics, it is worth mentioning here that these earnings are right now are recent numbers, and if we're likely to go into a recession or if semiconductor manufacturing takes a big hit coming up, these earnings multiples could go very high as earnings become depressed. But as of right now, this is all we can analyse. Forward PE ratio of 10, far below the S&P 500 averages. Historically a good price to pick up Intel. PEG ratio of 0.43, an exceptional valuation versus Intel's historic multiples for this. This means it's far below that one bargain ratio that Peter Lynn just spoke about and that I often go by. 0.43 is positively bargain territory for a PEG ratio. The one wart on this that I often look at is price to free cash flow. You can see the difference between operating cash flow, which is a price to operating cash flow, which is about 4.87, which is positively bargain territory, and price of free cash flow at 15.16. That's because they're spending a lot. They're spending a lot to go on the fabs, fabricating facilities. They're spending a lot to bridge the knowledge gap and bridge the manufacturing gap, the process knowledge gap that they've got with Taiwan Semiconductor and Samsung, and that is absolutely necessary, and that is something, if you want to invest in Intel, you just have to get on board with. They still are a very free cash flow generative business, but that does of course make the share buybacks that have previously happened are kind of on pause at the minute, and the dividend, while they've committed to maintain it for the time being, it's now 4% yield because the company's share price came down so much. That will start looking frail in the future, in my opinion, and I don't think that is an absolute guarantee, but that is not a crucial part of this thesis. But as of right now, a 4% dividend yield to hold this stock at this prices, I think is decent. Final stage of my analysis is to work out an intrinsic valuation and a fair value to pay for this company by doing a discounted cash flow analysis. For this, I'm using a 7% free cash flow growth rate for the next 10 years. Over the last 10 years, they've averaged 8.5% free cash flow growth, and that is with it basically halving in the last year. Over the last 5 years, they've averaged 7.3%. I think around 7% is reasonable, if a bit conservative. I think if Intel continues to succeed, in the long term, this will be much higher, but in the short term, the free cash flow is going to be depressed. I think an average of between 5 and 10% is about right. I think on the high side, this could become a very successful business. The semiconductor industry is predicted to grow high single digits a year on a compound annual growth rate. Intel should track this very well, and I believe that they can average 7% free cash flow growth over the next 10 years relatively easily. So I think this is relatively conservative. Of course, this is the section of the analysis that's firmly up for debate, but I think that the revenues grew 7% on average over the last 10 years. I think they can track this fairly well with free cash flow. So I think this is reasonably conservative, but of course, that is up for debate. Terminal stage growth rate of 4% and a 9% discount rate for the long-term return to the stock market. That gave a fair valuation of $37.20 versus today's stock price of $36. About fair value. I'm not going to quibble over a dollar here and a dollar there. That is about fair value. This is a reasonable price to pay for this company, in my opinion. Not overly cheap, not overly expensive. It thoroughly depends on what you think Intel's free cash flow is going to be. I think at 7% free cash flow growth, this is a reasonable investment right now if you believe in the prospects of this business, which I do. However, I'm not a financial advisor. You should not take this solely on my word. You should do your own calculations. You should do your own research. Do your own due diligence. And let me know in the comments what you find. Let me know if you think Intel's an absolute stinker. Let me know if it's a sleeping giant. Whatever you think, let me know. And like and subscribe if you enjoy the videos. I'll see you again next time.